Let's start today's market talk. The best require a margin of safety always. So, at such elevated levels, anything can happen in the stock markets, and you ought to be able to conduct your affairs so that if most extraordinary things happen, you're still around to play the next day also. So, just don't go all in every time. Now, the market setup, as I see it, the difference between India and the world's growth rates is the one which will attract capital to our shores. India's differential in growth, GDP growth is roughly around 4% from the average of rest of the world. Balanced people are around 2.5, 3% maximum. So that there is a differential of around 4%, and there is macro stability for investors. So for this to keep going, there is a need for investment and consumption, because you can't just do investment without consumption. Now, as we had discussed, retail traders and mutual funds are the ones which are driving this market. You would have all noticed post-COVID number of retail participants increased with better skill levels. We heard, I think, recently that so many 3 odd crore of new demat accounts have been opened, and that's why CDSL went up. And mutual funds with so much of money coming in, small cap funds and all, are driving this market. And volumes in option markets, they are the key drivers which are taking the stock prices. So the impact of FIs and DIs and HNIs have reduced. Uh, what happened at end August was that there was record auto sales, buoyant GST collection, high electricity consumption, strong rail freight, coal production was high, and a good manufacturing PMI numbers, which added to the optimism. So the September started on a positive note on strong economic data, and the action in mid caps and small caps indices have continued. The concern is that crude is already at 10th month high of 90 per barrel. Okay, let's discuss a few stocks. Reason for staggering rally in BSE is the initial success of its effort to revive trading volumes. BSE was that poor cousin of NSE, but measures to revive volumes are showing now in success in basically in derivative segment. They have started these Bankex and Sensex derivative contracts with reduced lot size and changed their expiry days. So the volumes have doubled, and subsequently also they sold some 5% stale in CDSL for 518 crore and all that. Hence, there is an interest in BSE, and it has doubled in the last 3 4 months. Now, Kotak Mahindra Bank, again, it's a fundamentally strong bank with a growth journey ahead. It has presence across financial services, which offers great value unlocking potential. NIMS for Kotak Mahindra peaked at 5.75. Moderation is expected. Please switch off your volumes. And if someone has got his volume on, please switch it off. Moderation is expected. Asset quality is best in class. Number of subsidiaries provide presence in financial services, and the price to book has corrected to 2.3 times FY25. So where it looks now starts looking attractive, and with Uday Kotak is out now. So, but he has, I think, 26% stake in the bank. So he has a skin in the game. So he will ensure that the bank performs well. Now the best thing is these railway engineering stocks, which were earlier trading at 7 to 8 times P, are now trading at 14 to 20 times P. But re-rating is basically due to growth certainty. RVNL and IRCON have shown 20 to 30% revenue growth. Order book to revenue is around 3 times. IRCON FY24 expected EPS is 9, and RVNL is approximately 8. So you can judge that PEs can get re-rated to around 20 times. Now the technicals, if you see, this is Nifty. I have taken this Fibonacci retracement from the high to the recent low to around 19200. So in this rally of this is a daily chart. In the last week, we have moved ahead above the 20 DMA, and now we are, after crossing the 61.8% level, that is around 19,700, we are now heading to the all-time high, 20,000 in a week or so. So it can either go straight up and then reverse from there, or maybe move sideways and then move on someday on some positive news. But this is inevitable now, and we'll have to now see what is the life beyond 20,000 from here. And the movement was very sudden, and then subsequently the short covering takes place, and then the market went up. Now, if you see the weekly chart, uh, it's making a flag and pole. So this is a pole, and then there is a flag. And now, if you see there is a breakout from there, it can go up from there. Now, for this, the lower trend line would be the support. So after this, they break this range, then the movement is upward only from here. So, and the length of the movement is generally the length of the pole. So if you see the length of the pole from 16,800 to 20,000 is roughly uh, 3,000 points. So you can imagine from 19,000, which was 19,200 odd, which was the base of this rally, uh, 22,000 is possible once this move takes place. Now, Nifty Bank, which was a weaker one, it got support on Friday due to that RBI removing the ICRR restriction. So it went up, and now it went to 61.8% retracement level, but then it came down from there. But it is still above the 20 EMA. Hence, the 20 EMA should provide support from here. And HDFC Bank revived around 50 rupees last 50 to 70 rupees last week. So that is the reason for the move here. While ICICI Bank and Axis has been weak. Now, this is the one index which is doing very well, and I was telling about this Nifty PSC index. This is a monthly chart. If you see, it has crossed its lifetime high, which was achieved in 2007. So, when was the last bull run? After that, it has crossed that, and it's crossed it decisively. So, remain invested here, and it may go to new highs with so much of projects coming up, and government announcing so many railway and other infrastructure projects. Uh, the tiger of the last week was, in my view, Coal India. It surprised everyone. Like you see the monthly chart, see the strong green candle from around 220 to 30 levels where the stock was floundering. It went straight away 50, 55 rupees to around 280 level. So it is looking strong. This is like a breakout from this level. It can go any level because it's a good dividend yield stock and underpriced. Nifty IT index, as I have been telling every week, is now looking is had a breakout from its 52-week high and broken the upper trend line or the upper resistance which it was to face. So now it is likely to go up. Let's see where it reaches because the IT narrative has improved. This is the BSE Momentum Index, which I was talking about last time. Plus, see these stocks, they are doing very well, all of them, and they are all mostly in FNO, so they are doing well. Now, this is the pitchfork I did here. So now you see, if you project it up, this BSE Momentum Index, this has got now 7 green candles, and it can head to the upper trend line of the pitchfork and take support at the lower trend line. So this is the one where there is momentum and the support which is coming for the markets. Now, Midcap index, if you see daily chart above all averages and continuously green candles and looking very strong. Similarly, small cap index again, it took off from March and now it's above the it's showing all green candles and above the 20 EMA. Now, this is the stock which I was pretty bullish on because, in my view, this had the strongest or the best results among all the stocks. Now, it has broken out of this symmetrical triangle pattern and is likely to go up another 50 to 100 rupees from here. That is Indusind Bank. It's slightly under-owned, so there is an opportunity here. Now, if you remember, uh, let's see the Nifty chart again. Now, Nifty gave an opportunity in in August end to buy here, right? And as we have seen, the PSC, railways, power stocks are on fire. Coal India, as I discussed, was the leader last week. I've never seen it move 10-15% in a short time. News flow that all of them will benefit from this G20 meet and all that is the one which is powering them. Obviously, everyone will not benefit, only few will benefit, so the correction will come. So, the point here is if everything is positive, then those who are long are likely to book profits at their targets, which would be roughly around 9,900, 19,900 or 20,000. So be careful that market may dip from there. Okay. Now let's cover the stocks I wanted to cover. First one is Minda Corp, one of the leading automotive component manufacturing companies in India, expected to perform better than industry on the back of new product launches, higher kit value in the EV segment, that is electric vehicles, strong premiumization trend, and enhanced localization in the wiring harness business. Wiring harness is just a group of coils which are put together and from which are used for basic electrical currents and all which flow in a vehicle. So the wiring harness business constitutes 30% of the overall revenue. Indigenization of components will increase from current level of in-house production from 12% to 25% and will boost EBITDA margins by around 15 to 20, 200, 150 to 200 basis points. In the next 3 to 4 years, focus will be on increasing the share of exports from 10 to around 16 to 18%. Products such as smart keys, die casting, wiring harness will be the key growth drivers for exports. EV product portfolio includes DC-DC converter, battery chargers, connected clusters, high voltage wiring harness, and EV telematics. Now, let me tell you what is high voltage wiring harness. These are the same wiring harness, but they carry high voltage in electric vehicles because current has to flow to different parts of the vehicle in electric vehicle. So, this is again a key affair. And EV telematics is the one where from remote level you can monitor the performance of the electric vehicle. So, uh, it optimizes charging, enhance battery lives, troubleshoot battery modules remotely. So these people are doing this. So this company is working on this. Now this premiumization thing is very good because that will improve the margins and that's why the profit after tax. They are also working on ADAS, that is Advanced Driver Assistance Systems for four wheelers, so that there is a better driver awareness while driving. And talked about this high voltage wiring harness. This supplies power and electrical signal controls the signal throughout the vehicle through connectors, cables, and distributors. So stock to keep in mind. Now, if you see their yearly revenues are growing regularly. If you see the EPS, it is from low single digit, it has become now at least double digit. Operating margins have improved, and stock is generally doing well. They are, I think, into looking to buy out pre-call or something like that. Here, if you see, firstly, the promoter holding is good. DIs are also decent. FIs are increasing their holding, and others are also constant. So then there is no pledging here. So the things are good. Now the forecast, if you see, EPS is likely to go to around 13 times. So if you give it 13 rupees now, so if you give it a PE of around 30 times, so it is likely to be around, you can easily put it at around 375 to 400 rupees. EPS growth is around, was FY23 was very good, 70 odd percent. And they are expecting around 20% growth from here. PE is decent, but it can grow. ROC, ROE, etc. is improving. Dividend, they are giving dividend. Margins are improving, gross margins, EBITDA margins, and profit after tax margins. Debtor days are stable or reducing. So debt is not much. Debt to equity is 0.3. So it is a decent company to look at. Let's see the chart. It was stuck at around this 200 odd levels, and it broke out from there, and then again it dipped to below its 50 EMA, and though it went off, so the level to enter it would be somewhere close to the 20 EMA for a target of around, as I said, 370 400. It can achieve in few days after this. Next one, which I find pretty interesting, was the Phoenix Mills, because it's a out of the blue kind of a thing. It's engaged in the operation and management of malls, construction of commercial and residential property, and hotel business in India. Phoenix Mills has roughly 14 million square feet of operational mall space by FY27 they will have. Presently, it is 6.9 million square feet, so which is operational. It is getting rental income, which is 17% rental income CAGR over the next 2 years or so. So they have a rental income of likely to be 2240 crores from 1030 crores in FY20. Of this, Phoenix shares is around 77% because that is their stake in all these malls. And they are looking for new opportunities in tier 1 and tier 2 cities across India's Mumbai region, NCR, Jaipur, Chandigarh, and all that. So the segment wise revenue, property and related services is 82%, and hospitality services is 60%. They, I think, opened a mall in Pune, Wakad. In Bangalore, they opened in Hebel, which is opening shortly. Then Indore, Ahmedabad malls opened in FY23. What is going to happen is the festive season is now coming after the rains. So again, they would have better revenues, and all the malls will have better footfalls. And recovery in multiplexes will also lead to aid consumption for the malls only, because multiplexes are mostly located in malls only. So if you see the FY25 EPS is around expected is around 57.58. You can easily give it a PE of around 35 to 40 times. So it should go above 2000 once the movement takes place in this stock. If you see quarterly revenues, they are constant and improving. Operating margins are also improving now. They have reached 61% in June. Other income and all profit before tax is improving. Net profit is improved, and the EPS is also improving. So if you see, FY25 is expected to be around 57, 58 rupees, and for FY25 earnings, it is at P of around 30 times. It has been trading. It can trade at higher P also. So this is a stock to be kept in mind. ROC, ROE, etc. margins are good, and with the more urbanization and high value spending and all which is taking place, so this is a stock to be kept in mind. Promoter holding is around 47%. Institutions are holding around 48, and mutual funds and all are holding. Insurance FIs have got decent holding, so you can look at it. Again, this stock after the March and all that, it has been constantly above the 50 EMA oblique 20 EMA. So somewhere around 20 EMA would be a decent level to buy. They are safe stocks to have because the variability in their revenues would be least now, because if there is no threat as such, because urban consumption cannot be stopped. This is the stock ITD Cementation, which I found it to be very, very good stock. It's engaged in the business of providing design, engineering, procurement, and construction EPC services for infrastructure projects in India. Now, just see, even if this railway project, oblique ship project, or that logistics connectivity starts with the Europe and the Middle East, it will have, maybe if even a larger group like L&T gets a project, they would still give subcontracts to other people. So all these infrastructure guys will come into play because they have their own unique services or the unique capabilities which they will bring in. Now, it's a key beneficiaries of increasing government focus towards infrastructure development and upgradation of railways and metro projects. It is targeting opportunities in marine and metro projects, including projects from Port of Singapore, DP World, which are which is a logistic company, various international projects from various countries like Maldives, Bangladesh, South African countries with projects funded by Government of India. Company is confident of receiving total order intake of around 7,000 to 8,000 crore during FY24, majority of which company has already received year to date, which provides a strong promising visibility to the revenues apart from strong bidding pipeline of 15,000 to 17,000 crore. It has got healthy order book, strong execution capabilities, and robust order pipeline and stable EBITDA margins. So the order book visibility is roughly 3.6 times their FY23 revenues. They are executing the Bengaluru Metro, the Ganga Expressway project in UP, which is a long-term project. I think only 20% of it is executed, so there would be some revenue visibility after that. They got a project from Power Grid Company of Bangladesh. The expected EPS of FY25 is around 18-19. So presently it is pretty cheap. At 15 time P also it should reach around 270, 280, and it has shown 67% year on year revenue growth in the last quarter where the re-rating took place. Its parent company is ITD Thailand, which is a leading infra and construction company in Thailand. Now let's see their quarterly revenues. So this is the reason where the spike took place, because suddenly in June they showed good revenues. Actually, March also revenue growth was good, but in June they showed good revenue. And if the June quarter is 1833, so you can imagine what will be the year end, because most of their projects are get completed or they get money in the end of the year, March, that is March quarter. So EPS is growing, margins are roughly reaching double digit. EPS is growing, so this is a stock to be kept in mind. Now, if you see, they're expecting a EBITDA margin of 10 in around FY25, and debt equity is under control. Debt is actually decreasing. EPS is likely to be around, as I said, 17 to 18 rupees in FY25. So, so that looks strong. Debtor days are stable. So presently for FY25, it is at 11 times, which is very least expensive. So I someday people will look at it and this stock will start moving. Now the key orders which they have secured during the current and previous year, as I said, they've got an order from Marine order, uh, 400 kilowatt double circuit transmission line in Bangladesh, six laning road project in Uttar Pradesh, West Container Terminal in Port of Colombo, Sri Lanka, Jawaharlal Nehru Port in Maharashtra work, Thal Sena Bhavan in Delhi, and filling and civil work for coke oven project at Hazira plant, Gujarat. This is their order book, this thing. So they are having orders in all kind of construction work and EPC. So this is a stock to be kept in mind. Now, if you see, it was generally around their 20 EMA or taking support at 20 EMA. Now, once this quarter results came, the stock shot up, and now it has corrected. So around 230 to 20 at these levels, this is a stock to be bought for long term because it is relatively cheaper as compared to the other construction and engineering stocks. Now, there is a thing about long straddle. So quickly, I'll cover this. So, long straddle strategy is as long as the market moves, irrespective of its direction, a positive PNL will be generated. To implement a long straddle, all one has to do is to buy a call option and buy a put option. Ensure that both the options belong to the same underlying, that is, both the options belong to the same expiry and belong to the same strike price. I'll give an example. So this is the option chain data of Nifty for next week's expiry. So if you see on 8th September, so presently the level is 819. So at the money option is 19850. So the call side premium is 73 and put side premium is 95.6. We will take this strike price to take a straddle for this thing. Let's see how it works. So long straddle would require us to simultaneously purchase the at the money call and put options. 19850C is at 73 and 850P is at 95.6. So the if you buy both of them simultaneously, your options would result in a net debit since you're buying an option of rupees 168.60. Irrespective of the direction, the gain in one option is good enough to offset the loss in other and still yield a positive P&L. Only thing is that it should there should be big volatility from here. Now, let's take some scenarios. If the market expires at 19,500, put option makes money. This is a scenario where the gain in the put option not only offsets the loss made in the call option but also yields a positive profit and loss over and above. So at 19,500, 19,850C will expire worthless. Hence, we lose the premium paid, that is rupees 73. 850p will have an intrinsic value of 350. So after adjusting for premium paid, that is 95.6, we get to retain 350 minus 95.6, that is 254.4. Hence, the net payoff would be 181.4 rupees. Now, scenario 2, this is the lower break-even point. Market expires at 19,682. In this situation, you don't make any money or lose any money. At 19682, 19850C will expire worthless. Hence, we lose the premium paid, that is 73 rupees, and 850P will have an intrinsic value of 168. So after adjusting for premium of 95.6, we get to retain 72.4. So the net payoff is roughly around zero only, minus 0.6. So that is zero only. Now, if the market expires at 19,850, that is at the level at which you had bought the call and put. Situation is very straightforward as both call and put option would expire worthless and hence the premium paid would be gone. So the loss here would be equivalent to the net premium paid, that is 168.6. If market expires at 20,018, this is the upper break-even point. In this situation, the strategy neither makes money nor loses any money. At 20,018, 19,850 CE will have an intrinsic value of 168. And after adjusting for the premium paid, that is rupees 73, we get to retain 168 minus 73, that is 95 rupees. 19850p will expire worthless. Hence, we lose the premium, that is 95.6. The net payoff would be again zero only, minus 0.6 in this case. And in case the market expires at 20,200, the call option makes money. This is a scenario where the gain in the call option offsets the loss in the put option, but yields a positive profit and loss. At 2,200, 19850 CE will have an intrinsic value of 350. And after adjusting for the premium paid, that is rupees 73, we get to retain 350 minus 73, that is 277. So P 19850P will expire worthless, hence we lose the premium paid, that is rupees 95.6. So the net payoff would be again positively 181.4 rupees. So you take a lot, if you have taken a lot, this is 181.4 into 50. That would be the net payoff. So what we see here is that the profits are unlimited in either direction of the market. Maximum loss is experienced when market don't move and stay at the money. So maximum loss is equal to net premium paid. There are two break-evens on either side, equidistant from the at the money option. Upper break-even, that is at the money plus net premium, and lower break-even at the money minus net premium. Volatility is the key issue which will make or break this straddle, because if it is not volatile, then you will not make money in this. Now the last thing which I wanted to cover is far month option is the one where there is the longest time left until its expiration date in a series. Now, so what you can do is it's a very simple thing, but you have to understand this calendar spread very carefully because to avoid risk. Now, in a calendar spread, use the same strike price for the near and far options and buy and sell equal amount of two options. A calendar spread strategy may involve selling September call and buying October-November calls on the same stock. So basically, this strategy is used if you would be bullish long term on a stock, but there is a chance that the price won't move much before the first option expires. It's like this year, say in month of March, when the market went to around 16,800, you are in the month of March, you were short term bearish on the market, but long term you are clear that markets will go up. So this is the time you could have sold a uh, call of March and bought a April or May call for Nifty, and this would have been useful because long term if you're positive and short term if you're slightly bearish. Great goal. Now the importance here is that the goal is to reduce the cost of far option by selling the near option. So when you sell the near option, you get the premium. It reduces the cost of the far month option while still being able to take advantage of a rise in stocks price over the long term. Long calls calendar spread is exposed to limited risk up to the difference between the premiums only. So this is the point here that don't sell calls or puts of the far month, because then your risk becomes or your losses are unlimited. So here what happens is once you're buying the call oblique put of the per month, your losses are limited to the premium only, and then you have reduced your premium by doing an opposite action in the near month. So this is about this far option. So I have finished. We will now take questions from here.